A key observation when looking at how people around the world manage risk is that individuals can be very good at managing small and idiosyncratic shocks, but really struggle when shocks become very large, systemic, or sequential. And in these cases, individuals need to share their risk management with others, from households and communities to the enterprise and financial system, getting support from the state and even the international community. The state has a particularly important role to play in supporting people's risk management because it has the scale to manage systemic risks. It can provide an enabling environment for the other systems to do their own risk management, and it can help to protect the most vulnerable directly. However, we know that states are not immune from government failures, and therefore there's an important interaction, an important role for the other systems to play in challenging the state to do better at risk management.
In all societies, the family constitutes the key pillar of support for individuals, both in good and in bad times. In fact, we see across the developing world, for example, a large share of households living with elderly people, which reflects living arrangements in which the elderly take care of the young and vice versa. Also, when shocks hit, be it, for example, illness or a crop loss or other shocks, family members step in to make up for lost income by, for example, working more hours or selling assets. But families also help individuals pursue opportunities. And this is reflected in the progress that has been made in many human development indicators, for example, in infant mortality or education attainment.
Communities, sort of local informal groups, really help their members to manage a lot of risks. They in fact sometimes are the only real safety net that poor people have access to, especially in low-income and fragile countries. There was this village in Tanzania with just 120 people, and it has no less than 40 different mutual insurance groups, things like burial society or shared agricultural labor, or they even patrol the village at night. And that's pretty much the pattern everywhere you look, that community groups are very concerned with health risks, with income loss, with crime and violence. And they try to manage these things, but they're also quite limited in what they can achieve because of their small size and informal nature. They can only do so much. So pretty much we find that communities are so much stronger when they receive outside support, when they're connected to markets, to other communities, so they're not isolated, and to governments.
A vibrant enterprise sector can foster resilience and prosperity in multiple ways. It can help absorb shocks and exploit the opportunity side of risk. It can contribute to more stable employment, growing income, and higher productivity. For example, in the World Development Report 2014, we argue that multi-person firms can serve as a vehicle for risk sharing. It allows workers to specialize and firm owners to make more profit. A vibrant enterprise sector can also help facilitate more efficient resource allocation and innovation, protect workers, consumers, and the environment.
So the financial system can improve risk management by providing formal financial tools, such as savings. For example, bank deposits or liquid securities that help people build up buffers for rainy days and provide flexible self-insurance against small losses. Or credit, such as education loans or mortgage loans that alleviate financing constraints over time and help people pursue opportunities with greater flexibility and resilience. Or market insurance that helps people cope with large unexpected events such as loss of house due to floods or loss of income due to large changes in commodity prices.
Managing risk is important for development because countries face aggregate risks. individuals by themselves are not equipped or are unequipped to deal with these risks. So it is the unique and pivotal role of the national government to deal with these risks. For instance, implement policies to mitigate or cope with financial crisis or with high inflation. So the best way for governments to conduct macroeconomic management is to develop a framework that provides policy responses that are not only credible, but are also transparent, predictable, and sustainable. Credible in the sense that people believe that the government is going to follow a policy stand throughout the horizon of the shock that they face. Transparent in the sense that the government has to effectively communicate and be accountable to that policy response. Predictable to the extent that market participants would somehow be aware that the country is not going to provide a policy response that is off the mainstream. And sustainable, that they have to have built-in buffers in order to finance those policy responses.
International community has a very important role in the process of development and risk management. We say in the report that unmanaged risks do not recognize boundaries, and financial crises and pandemics, once initiated, they can circle very quickly around the globe in an interconnected world. Failing to address these risks, in fact, poses a significant challenge to the goals that the international community is trying to achieve, ranging from reducing extreme poverty into boosting shared prosperity and ensuring that the income distribution around the world is as equal as it can be. But these risks cannot be handled alone by agents or countries. And we argue in the report that such risks, managing these risks, require the existence of international community, not only for cross-border risks, but also for risks that are just too large for a country to deal with on its own.
As you have seen in the course, there is no silver bullet, no single policy, but a set of cohesive policy recommendations that can be applied to different systems in society. For households, we recommend universal health insurance and conditional cash transfers. For communities, we recommend public infrastructure and services that can be implemented with the collaboration of local communities. For enterprises, we recommend streamlining regulations and improving public services so that both flexibility and formality in the economy can be advanced. For the financial system, we recommend macroprudential policies to diminish the risk of a systemic financial crisis. For the macroeconomy, we recommend countercyclical monetary and fiscal policies to reduce the impact of shocks coming from inside or outside the economy. And for the international community, we recommend an incremental approach towards global agreements, especially when we have to deal with complex global risks such as climate change and global warming.